do, and welcome to On the Mark with Mark Pappa. I'm Gary Byron. Mark Pappa, of course, the president of Financial Resources Group. You can find them online at www.frplan, that's F as in Frank, rplan, frplan.com. You can, and by the way, when you're on that website, there's a link to their YouTube channel. He's got a YouTube channel. If you can go there on your own, you can go directly right to YouTube if you'd like. Just make sure in the search field, you just type in Mark Pappa. That's MarkPappa 5207. Okay, Mark Pappa 5207, and you'll get to his YouTube channel, which is really cool. So if you missed this episode or parts of this episode or any of the other episodes that we have, he's got them all right there for you. Lots to learn. I would write this phone number down. You can call it right now, but I don't want you to miss the show, so you can call it at the conclusion of the show or on Monday, whatever works better for you. Okay, I just write it down nonetheless, because it's going to greatly impact your life, really your future, your retirement, which is your life. 860-657-8380. Let me repeat that. 860-657-8380. And by the way, if you missed any of those points of contact, I will repeat it periodically throughout the show. Good morning, Mark. Great to see you.
Good morning, Gary. How are you today?
I am peachy. How are you doing?
I'm fantastic. Settling into summer, it's going by way too quickly.
Oh, doesn't it always?
Yeah, it sure does. But I'm staying positive. I'm going to take the best of every day. So anytime I can enjoy this weather, I'm going to.
I'm going to pay you a compliment, too, here.
Oh, thank you.
When you walked in the door, I'm like, man, you look like $1 million. There's something about you today. I don't know if it's a glow. You got a nice tan going on. It's a great shirt. You look real. You look business casual.
Thank you very much. I also dropped a few pounds.
You did, yes.
I'm 233. I have a goal weight of 225, but I was as high as 240.
But you're a tall guy, too, so.
Over the summer. I know, but, I can't make excuses either. I wasn't happy at that weight.
What's your weakness?
Snacking at night, no question about it. I think I fall in the same category. And then carby snacks, too, so. The good
potato chips and
popcorn. Little trick is that Trader Joe's has this awesome mix of cauliflower and broccoli, and then what I do is I buy the peeled garlic and I steam it, and I pop that in the pan, and I just eat that as my snack now. So little things like that do help, and then obviously working out daily. I just want to make a little correction to the announcement. I'm not quite yet president of Financial Resources Group, LLC.
But you're on your way, though, aren't you?
We have a hard close on 9/30, September 30th. This one we're eventually going to close. We'll sign up on the paperwork soon. So I'm excited about that. And in addition, we have a new website coming out, too. So I have a new website, same www.frplan.com. And all of these shows the replays will be uploaded to that website under podcasts. So you'll be able to actually go to our website and listen to anything that you missed here on our website. Further, I also have an ad campaign rolling through Instagram and Facebook, which you remember that Three Little Pigs test?
Yes.
Okay.
A couple weeks ago.
So we're going to do 3 questions from the Three Little Pigs test on there. People are already answering some of the questions about retirement, and I'm trying to get them on the phone. It's really hard these days.
People are everywhere.
And people send you right to voicemail. But, bottom line is I hope the people do pick up, because we do have a lot of very valuable things that we can do to help them in their retirement. So anyway, so that's the story, Gary.
I'm happy to hear that, and congratulations on you got a closing date that's coming up. And really quickly before we get into the meat and potatoes of the show, once you become the president, you gave a date in September. What changes do you foresee your business undertaking?
Well, I think we're going to make more investment in community outreach. I'm going to be doing a September, October seminar called the Roth Blueprint. And it's going to show people different ways to actually convert their Roth IRA.
Okay.
We can do that in a structured manner over time. In addition, I have a separate entity I just set up called Glastonbury Tax Strategies that will allow you to utilize, IRS compliant with legal opinion strategies that are available to private equity, hedge funds, large corporations. We're bringing that down to the level of people who are accredited typically, so much smaller than big corporation, but allow them to be able to offset the taxes on their conversion. In addition, we're going to show them a way to actually have someone else pay the taxes for you upon that conversion. So we're really, really excited about that opportunity. I have a feeling it's going to be oversubscribed, and I'll probably have to book some additional dates. That's the feedback we're getting.
Wow,
but,
that's a good problem to have.
If you're going to stay in a big IRA, in a qualified account, you have a big tax trap, and you basically can kiss 25 to 30% of your money away to taxes. So if you have $1 million 401k plan, you really only have $700,000 to live on if you're in a higher tax bracket. So it's not really all that attractive.
No, it's not.
So we want to fix that for you. We have ways to do it. So that's one of the most exciting developments. In addition, just investing in technology and sort of making some updates like the website. And again, more community outreach and trying to educate folks on things that are available to them that they may not be aware of.
Are there periodicals or things that you read on an ongoing basis, knowing how everything is so fluid?
I'm constantly learning, Gary. You have to stay ahead of your competition. And I think that there's a lot of folks out there who are great, and then there's other people who are just flat. They haven't updated their skills in years, and they do the same old thing. That's where I can come in and clean those accounts up and make people's retirement, I believe, a lot better than the cookie cutter retirement that they were getting.
Good. This past week, you can probably address this a lot better than I can. The big news, it came out, I believe, on Tuesday or maybe Wednesday morning, that the Trump administration reached a trade deal with Japan. I thought maybe we'd start there and get your comments, get your thoughts on that, and we'll take it from there.
Yeah, Gary, that was a big deal. Japan's one of the, G7. It's one of the largest economies in the world. It's one of our biggest trading partners. But for many, many years, it's been hard for American car companies or auto companies or American products to penetrate their economy. Japan is a very unique economy. It has an aging population. Their birth rate is very low. It's not growing very much. They needed to make a deal with the United States. They needed to open up their economy more. It was, I don't say really closed off, but what Trump did in this case is he's going to impose a 15% tariff on Japanese imports, reduced from a threatened 25% rate, and 27.5% specifically on autos. And in exchange for that, Japan's committed to $550 billion in investment packages in the United States. That's expected to create hundreds of thousands of jobs. As you know, we're trying to become manufacturing giants once again and bring things home, repatriate our, for lack of a better term, our manufacturing and diversify away from the reliance upon China being the world's greatest manufacturer. So we tried that. Ross Perot was quoted back in 1992, 93 when he ran, saying basically that, NAFTA would create a giant sucking sound. And you can see the evidence of that right throughout our entire state. Look at empty factories in Waterbury when you drive by, Hartford, Bridgeport. Those are buildings that could all be repurposed, and hopefully we can fill them up with jobs and uplift everybody in our economy, people who, really deserve to go to work. And don't feel that they don't have opportunities. We could start creating them.
But didn't we already have a pre-existing deal with Japan?
I'm sure we did, but I think this just opens it up to a much better deal. It's also going to open its markets to U.S. goods, including cars, trucks, rice, and agricultural products. And the U.S. is going to receive 90% of the profits from those investments. So I think it's a very big deal. Obviously, Trump called it massive because he loves to elaborate. Prime Minister, his name is Shigeru Ishiba, welcomed the agreement, noting its benefits for both economies. So he certainly didn't embellish like our president did, but felt that it was a good deal. So it seems like hopefully all sides can get along.
Let's hope. Let's look at the big picture, though. How overvalued do you think the top 10 companies in the S&P 500 right now are? And how does this parallel the AI and, the momentum trade to the dot-com bubble?
Well, Gary, that's a great question. And what's interesting is artificial intelligence is now where we had algorithms and high-frequency trading. AI is starting to actually control the market even more than in the past, which is getting a little scary because, but it's getting smarter and smarter every day. But I would say that the AI trade, with all the money being invested in infrastructure, is starting to resemble. The bubble is starting to blow up. It's certainly not at the dot-com level yet, but here's a couple statistics. The S&P's trailing PE ratio stands at about 25.9. So PE for our guests is price divided by earnings, and it's a simple metric to determine how richly valued the stock market is. If the market's at a low PE, obviously stocks tend to be undervalued. It's a great time to buy. If it's at a high PE, all right, you have things like, then it's probably time to start, unloading a little bit, taking some profits or rebalancing your portfolios. So 25.9 is a skewed number, but it's well above the historical average of 19.4 since 1971. So we are starting to go into that territory. The NASDAQ 100 is even hotter at 34.3 compared to its historical median of 20.7. So if you look at where the markets were in 2022 when they all crashed, their PEs were much, much lower. So what we want to do, Gary, we want to build portfolios that don't have that high PE, that high amount of risk. We don't mind taking some risk. We don't mind trading in momentum, but it can't be the only thing you trade in, because what comes up, also comes down. And the upside is sexy, but the downside could be murderous. So we want to avoid that.
So those PE numbers, look, they're eye-opening. Historically, the S&P 500's long-term average PE is around 16 to 20, right? So
yeah,
we're 30 to 50% above that. But as I'm listening to you, shifting gears to our retiree listeners, many are worried about protecting their nest eggs, and particularly in down markets. How can they safeguard their money if we see a pullback?
Well, that's a good point. And right now is the time to do that, which is why I would recommend people give me a call. This is not a market where you can use a traditional 60-40 stock bond portfolio. We have interest rate volatility. We don't have a lot of certainty that interest rates are going to get cut. Well, if they do, your bonds will go up in value, but your income will go down in value. With the rate hikes, and I'm going to talk about that, we need to take a look at the bigger picture here. 10 companies by market cap make up over 35% of the S&P 500's weight. So think about this. I own 500 stocks in the S&P. 35% are in the top 10. So how diversified does that feel? Right?
No.
35% of your money's in 10 stocks, and then the other 490 make up the difference. So we want to be able to diversify away from that unprecedented type of concentration. And then when you break out price to earnings, NVIDIA's at 53 to 54 times, Microsoft's trading at 40 times, Apple's at 33 times, Amazon's at 37. These companies are not, NVIDIA is growing, but these other companies are not growing at their rates that they did when they were younger. Even Alphabet, they have some problem with AI and the transition away from paid ads and clicks, the blue links. They're going to have to convert that quickly because that is a huge chunk of their revenue. So that's trading at 21 times. So that's probably a little bit, and then Facebook or Meta at 27.52. So these are very, very high numbers. You compare that to, let's say, JP Morgan, that's at 14.31. So I don't want to throw a bunch of numbers around, but the top 10 stocks are a problem. In all of our model portfolios, we diversify away from those top 10 stocks. In Mag 7, well, we will own some, but at the same time, we have a more equally weighted strategy, or we utilize an earnings-weighted strategy so that we don't have that big level of overconcentration. So just one other thing, Gary. In comparison, if you take a look at where the markets peaked, it was about 80 times earnings back in the day of the dot-com bubble, and then the top 10 stocks had a median PE of 46. So we're looking at some pretty overvalued companies. We had Cisco's and Oracle's. They're still around. Cisco hasn't done much since 2000. I think it's still below its peak. But the dot-com crash caused trillions of dollars to be wiped out. The NASDAQ dropped 78% in 2 years. So people need to be aware of this, that God forbid, you know what, this AI build out turns out to be a big bust. I mean, they're spending $500 billion on data centers. Let's say that turns out to be a bust. Let's say AI, it doesn't going to need all that computing power, isn't going to need all that, these giant data centers, and it just gets smarter and quicker and more efficient, which technology tends to do. I think AI, the speed at AI's adoption is going to happen much, much quicker than anything in the past, the regular internet, fiber optics, or even Moore's Law, where they said computing power was going to double every 2 years. I think the intelligence is going to go a much, much more rapid pace. So it's going to be interesting to see. We got to be cautious. You can't have 10 stocks control your entire portfolio. And for those of you who are, making what the S&P is this year, I know you're happy. However, understand that you are, there's a lot of air underneath those stocks, and there's a lot of risk underneath that could be, take your portfolio down. And so we want to be careful. We want to be able to hedge against that risk, which is what we're very good at doing.
I know that we discussed in past episodes, like when we covered the American Institute for Economic Research, right? What is that? The AIER research on withdrawal strategies. The AIER references around there's a dozen different withdrawal strategies in their broader work. What does that include?
Okay, so just to kind of recap that, and again, this ties into why retirees can't afford big drawdowns in their retirement. There's a thing called sequence of return risk that can devastate your portfolio in the early years of your retirement. And what happens is if you start off retiring in a down market, and we have charts to prove this, you from 2000, so I talk about the dot-com bubble, to 2019, if you stayed invested in the market and just took out 4% a year, okay, or 4% a year, we show most people, because of those drawdowns who are taking their income, running out of money in 20 years, flat out running out. Now you reverse that, so we take that same index and show the later years starting off with an up market and ending with a down market, the same down market, and people will still left with plenty of money to live on. So sequence of return risk is huge, and that's a presentation I've done before. I'm going to start doing it again. It's hard to get people to understand that because I don't think a lot of advisors, I hope they're talking about it. But when markets are up, everybody's a hero, and then when markets down, no one wants to pick up the phone. Where we want to be able to pick up the phone like we're able to in a down market and say, hey, you know what? It's not that bad. You're going to be fine. Let's figure out where we're going to get your income from this year. And don't worry, you don't have that sequence of return risk that the people who are down 20% or 30% in the NASDAQ in 2022 had. So that's what you want to be able to protect against. So, but those withdrawal strategies and picking the one of those 12 that's going to be best for you, Gary, is going to help you diversify away from that sequence of return risk. So I'm glad you bring that up.
Did you want to go into those? Because if you do, let me just do this really quick, folks. You're listening to On the Mark along with Mark Pappa. I'm Gary Byron. Mark is with Financial Resources Group. You can find them online at frplan.com and at 860-657-8380. Again, 860-657-8380. His offices are in Glastonbury, Connecticut. We will, and if you missed any of those points of contact, I'll make sure to repeat that more towards the very end of the show.
Yeah, no, we will definitely get into that. Also, I just want to highlight, Gary, the safe buckets of money as well.
Yes, right. Please.
So obviously, it's important that people have an emergency fund, right?
I agree.
We also recommend they get some type of home equity credit line, a line of credit, or as I mentioned in the previous episodes, the HECM, home equity credit method. So,
how much should an emergency fund be? Like just something you keep in your savings, like that's
I would
accessible.
say 6 months is typical. 6 months
months salary,
expenses. We get lots of calls where people are tax trapped in IRAs, and I'm working with them to untax them. But they call us and say, "Hey, where do we need to get some money out? We have an emergency." They don't want to borrow against the house because rates are terrible right now. So we have to come up with ways to figure out where they can get their cash. So we see that a lot. But emergency funds are super important to have that money in cash, safe money like CDs, money markets. To have a good chunk of money there is not a bad thing. That dry powder, you don't need to take the risk you did when you were growing your assets. You're growing that portfolio. You need to protect now. So we need that buffer. And you don't want to be liquidating your portfolio in a down market. And that happened to some people I know that had homes in Florida. The market was down 20% and they got hit with a hurricane. And all of a sudden, they're liquidating their IRA to get their house rebuilt because the insurance was slow to pay. So here they are hiring public adjusters. Who wants that risk? You don't want that. And this was somebody who is not a client of mine that came to me, and we had to jump through lots of hoops to try and help the guy. But it wasn't the most optimal strategy. No, I can't tell him that, but, that's what happened. So we want to make sure at least 2 to 3 years of living expenses in low-risk assets like CDs, money markets, short-term treasuries, they're all paying very good rates right now. So it's really not a bad place to be. Warren Buffett doesn't mind, right? He's sitting in it, making his 4.5% to 5% on, billions and billions of dollars. So I don't see why it would be inappropriate for you. You don't have to, take all that risk. In addition, bond portfolios. So I mentioned before how bonds could lose. So 2022, we had a very aggressive increase in interest rates. And then we saw what they call the Bloomberg Aggregate Bond Index. That was the benchmark for the bond market, just like the S&P 500 and the Dow for the stock market. That's the bond market. That lost 13%, okay? And if you take a look at what the 30-year Treasury lost, it almost lost 30%. And if you were in a diversified bond fund, you probably had some 30-year Treasuries. So if that's 40% of your portfolio just lost 13%, that was the money that you had in that was supposed to be safe? Think about that for a minute. You're losing 13% of your money. Now, if you're only making that bond portfolio is only earning 2%, 2.5%, and you're down 13, think about how long it's going to take just to break even on that.
Yeah.
Now, think about what it's going to take if you're taking withdrawals. How hard is it going to break even? Are you ever going to break even, or are you going to lock in a loss forever? That sequence of return risk. Once you lock that loss in, it's gone forever. You're never making that money back. So do we want to, protect clients from that as well?
You have to.
Because that is just not where you want to go.
That's a great breakdown, Mark. And we've touched on the safe buckets before, I remember, very recently, actually. It's like an emergency fund, kind of on steroids for retirees. And you mentioned bonds. Interesting point on their risks. So historically, then, do people really flock to bonds at the bottom of the equity markets? Is there any data on that trend? Or
there is data on that, and it is amazing to see that when the stock market is selling off, when people should be buying stocks, and the institutions like Buffett buy when there's blood in the streets, people are running to the bond market at record paces. And the reason why no one advertises the dangers or the risk of bonds is if I'm a big mutual fund company or an ETF provider and you have your money in my equity funds and you panic out, you're going to flock to my bond fund. So I'm still going to get paid. So what do I care? Do I want to scare people or still get paid? And that's what happens. So typically speaking, because bonds aren't as safe as that people predict, we still see people flock to bonds at usually the very worst time. So that's never a good thing. So yeah. Yep. And then what happens is the stock market rebounds and they're still sitting in their bond fund because they're still scared and they miss out on the rally back.
It's really eye-opening data. And look, I appreciate the historical context. Why does taking some profits off the table make sense right now?
Well, I would say it does make some sense, especially rebalancing your portfolio, for the simple fact that you just have such a fat concentration in companies. This AI trade has been basically is what carried us through 2023, 2024, and now 2025. That's what helped us rebound out of that 2022 correction when rates went way up. So I would say that it has legs. However, it is very, very concentrated in those top 10 stocks. So you want to help diversify away from those top 10 stocks as much as you can. Not saying you shouldn't own them, but you definitely want to help diversify away from them. So if you're in a standard S&P 500 fund, you may want to look at something that has an equally weighted fund, or you may want to take a look at something that has an earnings weight like we like to use, or something that's more equitable in its construction so that it's not biased just towards those top companies. Because, again, it's lifting up the market. Now, there's been broad participation, but like I said, if this AI trade goes bust, so goes the market.
We got to wrap things up. Before I do completely, though, is there a disclaimer that you have? And you've got this blueprint checklist thing. That you got a $100 gift card. You want to just talk briefly about that for a minute?
Yeah, so first things first, just please don't constitute anything I'm saying today. Do not act on this radio show as investment advice or tax advice. You want to consult a licensed professional. In addition, securities through our firm is offered through Financial Resources Group, LLC, a registered investment advisor. Insurance products, when we use them, are also through state licensed, obviously licensed in proper states. So I would say that, yes, I still have the $100 gift card offer.
Tell me about that. How do they obtain that?
Well, you obtain it by coming in for a 30-minute review. I'm going to ask you to bring back some documents, and we're going to sit down and we're going to do our checklist review. The checklist review is very, very comprehensive. It's a very big deep dive into the things we're looking to help you discover benefits you're owed that you're not aware of, hidden fees, hidden costs, liabilities, like, for example, your power of attorney could be out of date, which I'm going to go over in the next show. You want to make sure that you have a working, durable power of attorney, that you have a medical power of attorney that's stored online. These are all the little things that we do. So it's not just about managing your money and puffing out our chest when the market's up and not taking your phone calls when the market's down. And again, there's a lot of good advisors that don't do that, but I could say that the majority, it's just the majority of my competition. If they're working at a big bank, or they're in the bank branch, you're not getting the phone call like that, typically.
All right, let me tell you how you can reach Mark to schedule that 30-minute meeting, get your $100 gift card. He's going to, but what he offers you is certainly a lot more significant than a $100 gift card. Contact Financial Resources Group out of Glastonbury, Connecticut. You can find him online at www.frplan.com, frplan.com. More importantly, I would say call him, 860-657-8380. Again, 860-657-8380. For Mark Pappa, I'm Gary Byron. Thank you so much for listening to On the Mark. Until next weekend, have a good one, everybody. So long.